Good evening, ladies and gentlemen. Kindly settle down. The speakers already arrived. As usual, before we move on to the program, let me briefly tell you what's happening in MMA. Before that, let me warmly welcome all the viewers who have joined us online. As usual, if you have any questions, please share your question to the number what is on your screen. The speakers kindly agreed to respond to all your questions. And all the people who are here today, if you have any questions, we got a Mentimeter. You can scan, send the questions. Otherwise, there's a slips available. They'll pass it on to you. You can send the questions actually. I know this is a subject which you should have a lot of questions. If you have no questions, means you are very safe. That means you're not invested. Stay as it is, so you're safe, not to bother. Okay. Now, let me tell you what's happening at MMA next few days. First thing is we are also organizing a visit. We started a new initiative, which was there a long time ago, that factory visits and visit to some of the organizations which have done exceedingly well. And this time, with a lot of difficulty, we got a permission of a few members of MMA, maybe around 20-25 people, to visit TVS Siruseri. I know how many of you visited TVS institution Siruseri with TCS Siruseri. Now I want to check out how alert you are actually. Otherwise, TCS Siruseri, because that's one of the places where some 80,000-90,000 people are working, how the systems and processes are done. It's good to see how big organizations work and how systematic they are. So I think Venkat is coordinating. We already got a couple of nominations already there. 4 or 5, anybody want to do that? We are watching this 4 or 5 only because they're also screened so that the people who are really members of MMA, we would like to show them. Like this, every month we start visiting a couple of other factories. We are also tying up with Danfoss. We also try with some of the Deming Award companies so that you visit and seeing the place, seeing is believing actually. So anybody you're working in a company where you want to bring MMA members to visit your place, please do let me know. More than happy to collaborate and connect with my team so that they will visit you. And this is what is happening. Now, other than this, we are also having an event on 25th of March here on Tuesday. Very interesting event. The Good Boy Syndrome, a peculiar feature of being a man in the Indian context. Actually, this subject we also had a brief talk, a prelude of this event during Women Convention, because you understand the man, because from the time in childhood you listen to the parents and all the time teachers. The moment you go to educational institutions, the peer group impact is there, more impact from the teachers, the college. Then you go to the work, then he is HR manager, he's production manager, he is controlled by so many people, then he gets married, then he gets all the more controlled by so many people, including Mamiyar, Mamanar, wife and everybody. So what happened, a man control, although if you understand the psyche of a man, how well you'll be able to handle him actually, how well you'll be able to bring in the best out of the man. This is research done. A person, Karthik, has written a book on this, Good Boy Syndrome. It's good to come and listen, especially a lot of our leaders. A lot of people said women should watch this program. I urge and upon men should watch because men is not able to understand other men only. Man only is a problem actually. You can handle things better, managers. So come, it's happening on 25th. We have Ganesh Chella, again a great HR leader, Sharda Chandrasekhar, Lakshmi Narayan. So we've got a lovely panel to do that. Then on, this month has been we have been doing series of events for only women managers. We did a women seminar where women at work. We did a research paper published, and it happened jointly with Great Lakes Full House. Then we had a women managers convention last Saturday. We had a full house, more than 375 women attended. Top notch. If somebody has not seen it, I really request you to watch the video which is there already uploaded in our thing. Outstanding speakers. So you must watch that. Again, on 28th of this month, the Hindu World of Women 2025, recognizing excellence. We are the strategic partner for Hindu. This is happening on 28th. This is again full house. It's already sold out. If you are, I think we have more than 120 nominations. We have got accommodating only about 100 people from MMA. If you are there, come. Otherwise, this again is happening at IDC Grand Chola. Then April also we lined up a number of events on 17th of May. The next series of Read and Grow. Emotional Intelligence by Daniel Coleman is again a brilliant book we are going to be discussing. Then we also have a nice event on India as a global player, the challenges in a multipolar world. We got General Shankar who's going to be talking to us this is a Muthaya Memorial Lecture we'll be doing. We also lined up a number of other events. Please do come and you'll get the communication very soon. Join us. It will be very pleasure to have you with us for all these events because we bring this a high quality program only for your sake, and I'm quite sure you watch them and get benefit and share your feedback. It'll be very good. And this month we also shared the business mandate with some outstanding articles. Our business mandate this month is more than 150 pages. I really tell you, if you're not read it, if I send it to your magazine, please read them. Our team has taken a lot of other. We also got new WhatsApp introduced today onwards. You would have got messages from. It's already been sent. MMA business WhatsApp where you all that click of the button you can say you're attending, not attending, downloading all that. You're trying to constantly improve. I think they also got ISO certification done because we also want to check our process. So we want to be done. We also got Mentimeter. We are getting into technology quite substantially so that all our events are seamless and enjoyable for everybody. Today also questions can be sent by Mentimeter, all by written. Coming today's thing, Read and Grow series, the art of execution actually. The art of executions were relevant to that, how the world's best investors get wrong, and that is what is the thing. But I strongly believe my boss in the Air Force would tell me, you have to be a smart leader. You have to be a great execution. Actually. If your execution is good, you can survive any part of the world, any organization, anything. Actually. So execution is very important. Whatever you do, investment, ultimately what is said about investment. But this is one thing we always urge upon the managers. Whatever you do, trying to be a great execution, because you execute the thing as planned, as not planned, and you are able to counter some of the strategic happening, all that. It will be really, really very good, and it can never be a purple pumpkin in your life actually. It will be always a good orange pumpkin actually. So this is what is the discussion today is going to be happening is all about the investors, all about investment, and who can, we have got one of the finest person to speak all about is our friend Babu, because here the book, they say about 3 types of investors and how does it matter, and there are so many things are there which you're going to hear from him. Maybe, I don't know, it's ironical, it happened by accident. Because we are having the thing, at the last 2 days, the stock is also going up actually. Is it something to do, connection? I'm not sure. But SEBI, listen, they may say, but you are really fudging the market. No. Idea is, gentlemen, you listen to this because as an investor, as a person who would like to invest and safeguard your fund and how to behave yourself psychologically, all that you're going to learn is, I think you're going to have a fantastic time. The art of execution, how the world's best investors get it wrong and still make millions of rupees. Gentlemen, put your hand together to welcome the finest panel we have this evening, Babu Krishnamoorthy, Mr. Narayan, and Mr. Loganathan. May I request the panel to please take a place on the dais. Before I request Babu to take it forward, let me briefly introduce all the speakers for this evening. May I have the AV, please?
Mr. Babu Krishnamoorthy, founder of Finsherpa Investments, is a chartered accountant with 25 plus years of expertise in wealth management. He has co-founded Pelican Wealth and worked with Allegro Capital. A best-selling author and speaker, Mr. Babu actively promotes financial literacy. An avid reader, marathon runner, and Rotarian, he contributes to various social initiatives. A chartered accountant with 30 plus years of experience across manufacturing, banking, and financial services, Mr. Loganathan has held key roles at Ashok Leyland and American Express Bank in India, the UK, and the USA. Since joining Sundaram AMC in 2014, Mr. Loganathan has led sales, investment products, risk, and marketing before becoming Chief Business Officer. A chartered accountant with over 30 years of experience in capital markets and corporate finance, Mr. A.K. Narayan has held leadership roles, including CEO of a leading leather group. He has served as president of Tamil Nadu Investors Association and IFA Galaxy. A passionate advocate for financial literacy, Mr. Narayan has authored How to Invest Right and Prosper and conducted over 1,000 investor education programs.
Ladies and gentlemen, that's an outstanding panel for you this evening, and sit back, enjoy, relax, and keep making a lot of money. That makes you good. That will make MMA also good because you will pay MMA well then. Over to you, Babu.
Thank you. Thank you, Group Captain Vijay Kumar. And can we have a big round of applause for MMA? You know, in many of the forums that I'm part of, I don't think you have such a level of knowledge sharing as it happens in MMA. And this is a monthly feature of Read and Grow. And I truly associate myself with the theme that readers are leaders. That's the theme that MMA keeps talking about. And truly, it's only that we get more intelligent by reading and imbibing core values. So delighted to once again be in front and talking about another iconic book. And before I bring in my dear friends Loganathan and A.K. Narayan, a couple of quick points. Both Narayanan and Loganathan are known to me for almost 2 decades now, and both are, you have 3 chartered accountants among the 3 of us here. And I think I dare say cumulatively about 60 years of investing experience among the 3 of us. So I'm sure there is a wealth of wisdom apart from the book that you will find here. So hopefully we'll be able to share in the next hour whatever we can out of that wisdom that we have gained. Having said that, I just want to put a context to why this book. Till 2000, we are roughly exactly around the time when COVID was announced about 5 years ago, right? 2000, March 3rd week was when COVID was really announced and the stock market plummeted. At that point in time, we had X number of investors in stocks and stock market and mutual fund. In the 5 years that has followed, that number has, if not doubled, gone up beyond. So what took about 50, 60 years to build as investment base, in 5 years has doubled. So there is a natural interest in investing, stock markets, and today you can open an app and just press a button and you can make an investment, right? It's as simple as that. But like Warren Buffett says, investing is simple but not easy. And that is so true. Because everybody can invest in stocks or mutual funds or whatever be it, but there is no guarantee that you will make a profit. And that is true as recent as 2 months back when the SEBI chairman then, Madhavi Buch, was addressing a seminar. She said 97% of all the people, retail investors who played the F&O market ended up losing money. That's a staggering number. It's a large number of population of people, youngsters, who are putting in hard-earned money, but ending up with a loss. So I thought this is a great way to demystify some of those concepts that are necessary for people who are investing to really get behind some ideas as to how to enrich themselves. And so that's the concept. And before I go, I wanted to kind of talk about why stock market investing is simple but not easy, right? Because of few things. One is that just as the time when somebody is buying into the market or a stock, let's say you're buying a particular stock, there's also somebody selling. And this is quite ironical in the sense that you are thinking that stock is valuable and you're buying, and somebody is thinking that the stock is no longer going to go up and probably selling. So it's this, both of these have to happen at the same time for a transaction to get done. So it's very, so each one comes into the stock market with a different thought process, different perspective. That's the first important thing. Second is, there is no clear guideline. Do you sell when the market goes up or when the markets go down? Or do you buy when stocks go up or go down? There is no clear understanding. There is no one right answer, one wrong answer. This is why, while it's easy to execute a trade, while it's simple to execute a trade, it's not easy. So coming back to this book, The Art of Execution, I'm going to give a small introduction about the author. Lee Freeman-Shor is actually a practitioner. He is a researcher, writer, mentor, public speaker. Most of all, he was into fund management. In 2012, he was ranked among the best fund manager, top fund manager, managing assets in excess of $2 billion across 5 equity funds and 5 multi-asset funds. Lee holds a psychology and neurosciences master's degree from the King's College London and is a certified mentor and trainer. Additionally, Lee is also a law graduate from the Nottingham Trent University and the investment management certificate from the UK Society of Investment Professionals. The formula that Lee adopted in his investment strategy was very simple. Over a 7-year period, the book actually draws from real life experience of over a 7-year period. Lee involved 45 of the world's top fund managers and gave them anywhere between $25 million to $150 million to invest on his behalf. And his instructions were very, very simple. He told them that they could only invest in 10 of their top ideas. At any given point in time, they needed to hold each of these portfolios into 10 of the top ideas. It seemed at the outset a foolproof plan that had to make a lot of money. After all, these are among the world's biggest and best fund managers. So what could go wrong? They were the best in their area of work. They were the best minds on investing. But at the end of the time, most of the investors' great ideas had actually lost money. Shockingly, a toss of a coin to pick a stock may have actually given the same returns as those of the stock picks that some of these fund managers had done. But despite being wrong most of the time, many of these investors still ended up making a lot of money. That brings us to the question, how could somebody be wrong in investing and still be profitable? The answer therefore lies in 2 parts of everything that we do. One is in knowing, the other is in doing. The doing part is the execution. So there is something different about these investors that they do while they execute their trades that makes it profitable in spite of many a times picking the wrong stock or making a loss-oriented purchase. So that's what we're going to explore more. I'm not going to let the cat out of the bag yet. We still have a long way to go on this discussion. With that, I'm going to bring my dear friend A.K. Narayan here. A.K. Narayan, like Mr. Vijay Kumar had mentioned, is a seasoned investor, one of the founding team members of Tamil Nadu Investor Association, a man who walks, talks and breathes investing and stocks and so on and so forth. With that, I want to get his initial reactions on this book and what he thinks. Over to you, sir. It's on.
Thank you. Thank you, Babu. And good evening, all of you. Thanks, MMA Group Captain, Mr. Loganathan, for inviting me to be one of the panelists among the elite Mr. Babu Krishnamoorthy and Loganathan. I am really privileged and have a proud moment today to share my few thoughts. I always believe, of course, I am an author of a book. Reading is one of the best things one can do for many things, and all the more is important while investing. Whenever I go to a college, I always tell them that you have to read Economic Times or Business Line or Financial Express, one of the papers, to get to know what is happening, but many of them are little busy and unable to spend their time. Having said that, this book, like what Babu has made a wonderful introduction about this book, is a seasoned man. The author has made a good progress about various types of investors. If you really look at the cross-section of the investors today, everybody wants to have their portfolio do well. But what is happening today, if you look at our portfolios, we are not satisfied at all. We buy either at the wrong time or we sell at the wrong time our shares when we invest money, or while investing in a mutual fund, we somehow tend to buy it at a wrong place. So all these things are happening. So this author also says many topics in that. He calls somebody a rabbit who, according to him, these investors never be successful because of their bad traits. So different traits of investors are brought in this book in a nice manner, and ultimately he says it's all about execution of a trade, like what Babu said. And one place I could also read, the execution is the key for shares buying or selling. Likewise, in real estate, the location is the key. If you buy it at the right place, you are going to have a real good boom period. Likewise, execution is the key for share market. But we do not know which is top and which is low. That's the problem here with us. We are under the impression the market has gone up today thanks to last 2-3 days run up. So we tend to believe that the bullish market is going to go forever. But it is not going to happen. That is what one should understand now. Today, what I am seeing is every investor wants to look at his portfolio not day to day, but minute by minute, and think that they are making money. Everybody has become glued to their portfolio minute to minute. It's a very sad story. We are not supposed to look at that. You buy a piece of land, leave it for 20 years, 30 years. You buy gold and keep it in the locker for many years. You don't care about what is happening. But when it comes to shares, you look at it minute to minute, and then you tend to think that market is crazy, it has gone down or go up. So that is the first fundamental mistake which is happening in the overall market. In my opinion, my initial thoughts of this book is one has to tend to read the book and to see what kind of investor are you in this scenario. Some people are really disciplined investor. I think the focus in the book is, he says you must be a regular investor, a disciplined investor, a person who is having a diversification in your portfolio. All these things, whatever we say as a financial planner, holds good in any book. The investment books are not going to be different, I can tell you for sure. Even if I'm going to write another book, the principles are going to remain same. Look at long term and patient. These are the two virtues of investment. But we are not able to follow that. When I say buy it for long term and wait for long term, people are saying how long? Say 3-4 years, 5 years. No sir, I want to redeem it after 1 year or 2 years. It doesn't happen that way. Why different asset classes? We have different way to look at it. After all, we are having only 4 asset classes, understand that very well. We are having fixed income, gold, real estate and equity. No other class we have today. Only 4 asset classes are there. And why we should evaluate equity in a different way altogether and say it is a risky asset. It is not at all risky, but you should know how to tame it, how to work towards that and then do it. So this book talks more about how a person can invest money. A different yardstick is not required for you to do it, and then in a calculated way, if you take a risk, you will definitely do it. So these are all my initial thoughts, Babu.
Thank you. Thank you, A.K. Narayan. I'm going to bring Loganathan in. Loganathan, you've been a kind of a finance person. You have been in markets and for many years. In that context, if you can give us what your initial thoughts on this book and kind of how it resonated. That we can.
Sure. Thank you, Babu. Can you hear me, everyone? Yeah, good, good. Thanks, Babu, for inviting me. I've known Babu, as he said, for a long time. So it's nice to, be along with him on this stage. Thanks, MMA, for giving us this opportunity. Really appreciate it. Thank you, Group Captain, for your invite. Thank you all for coming. So before we start off, and get into the book, I would like to know how many of you here are investors? Wow, that's very good. That's a good number. So you're all investors in individual stocks or investors in mutual funds or a combination of both? Both. Wonderful. So then I think, we can really have a very interactive session. So fine. Before I delve into the book, just one disclaimer. I'm obviously from Sundaram Mutual Fund, but whatever I'm saying here is just my thoughts. It's got nothing to do with what the fund house is doing or, whatever experiences I relate are solely mine. Okay. So with that disclaimer, I will, start off in terms of what really was the takeaway for me from this book. So in 2 words, I would say was what the author says, materially adapt. And that to me was, one, it's really a very good investing lesson, but it is also a life lesson. Because in most of our, day-to-day lives, almost every other time, we have some hurdle. Something comes up, there is always something, and it is a question of how do we react to it? How do we materially adapt to this change situation, which is an adverse situation? It is a good situation, well and good. How do we, and that is what distinguishes successful people from the not so successful people. It is all about how you react. And he says that is the most important thing. So to me, if I had to capture this book in 2 words, Babu, it is about materially adapting. And here he says, what is materially adapting? He says that you bought a stock today, next week it is down 20%, what will you do? Okay, and that is when, everyone becomes a rabbit. As Mr. A.K. Narayan was saying, he distinguishes, the investors into 4 or 5 tribes. One of those is called the rabbit. And as you can well visualize, a rabbit is the least successful, because a rabbit, once it is caught in the, in the headlamp, headlights, it freezes. And typically, most investors do the same thing. I would say about 90% of the investors typically freeze. So he says that, and how do you overcome this? And his is very nice. He says that you should not take a decision at that point in time, because whatever decision you take at that point in time will be wrong. Because you're now so emotionally, distraught because your stock is down, the money is down, you have no idea what to do. So he said you should take the decision beforehand. And to me, that was very, very, enlightening, because it's a new insight saying that when you enter, come in with a plan. What is it that you will do if the stock falls 10%, 15%, 20%? And he says that not acting is not an option. You cannot not act. You will have to act. Either you will have to buy or you will have to sell. Continuing to wait, he said, is the biggest mistake you can do. And then he cites a lot of examples where he said that of all the losing investments, as Babu was saying, most of them are losing investments. Only a handful of them made money. Only of the losing investment, only 3% made money by trading. So which means pretty much everyone else froze. And here we are talking of professional investors, professional fund managers who are extremely wealthy, who made a lot of money. And if that is their case, then imagine what a layman investor who's put his hard-earned salary how is going to react. So to me, the point was that, materially adapt, and then have a clear plan. Then have a plan and then execute it. How do you execute it? Again, he says, automate it. All right. If the stock, you should have a clear idea. If the stock is down 20%, I'll either sell or I will buy. If it is a sell, he says, put in a stop loss. Sell it, get out, and then think afresh. If it is a buy, again, you put a stop loss, at that point it will buy. So that he says, take the decision making out of your hands at that point in time. The decision making should be made earlier. So I think to me, that was really the takeaway, that materially adapt, which I also find has far reaching implications in our day-to-day life. And has a lot more implication when it comes to investing.
Fabulous. Thank you, Loganathan. I think that's a splendid thought. Materially adapt to every situation, especially in life and in stock market. No 2 moments are the same, and it's very important to keep adapting. And we all are in this room proof that we have all adapted. Through COVID, we have kind of continued to adapt to a different lifestyle, and then we have come back successfully back to things. So those are all examples of how we have adapted to newer situations and thrived. So yes, that's what is one of the tenets of this book. But before I go, I just want to reiterate the point which Loganathan made. He said most of these fund managers lost a lot of their trades. And you know, a couple of months ago, I saw a snippet of Roger Federer talking at a graduation ceremony. And there was a very, very nice YouTube video that I saw, which says, in his entire career, Roger Federer had lost 52% or 54% of all the points that he had faced, right? So, he is the world champion for the longest time, and we would expect that he would have got so many of his strokes as winners. He says, in spite of losing 54% of all the shots I ever faced, I still became the champion. And that is what Lee Freeman is also kind of talking about. He says the best of fund managers also get things wrong. Not very dissimilar to you and me. Only thing is, when we get things wrong, like Loganathan said, like rabbits, we sit tight. We get caught. We don't know whether we have to buy more or sell more. And that's where the difference between a professional fund manager and somebody who is a novice comes into play. He says, you need to act at that. And in Roger Federer, he says, the moment I lose a point, I forget about it and focus on the next point, next opportunity to make the next point. And that's how he became a world champion. So, in some sense, the nugget that I derive is that don't focus on what has already happened. Look at how the next one you can make it successful, next one, so on and so forth. Having said that, I just want to bring a context. This book talks about 5 different behavioral traits of each of us in some sense, but he has alluded to investment managers, right? And like Loganathan mentioned, rabbit is one tenet of an investment manager who kind of does an investment with a preconceived thought, and then when things go wrong, he continues to stay put without reacting to it, hoping against hope, praying that the situation itself solves itself. And that rarely happens. And then he talks about 5 different other traits. He talks about people who he describes as assassins, people who describes about as hunters, then raiders, and last he talks about connoisseurs. I'm going to bring A.K. Narayanan and Loganathan after a little while to talk about which style do they relate themselves to, or which style they believe they have experienced in their life. But before that, I'm going to talk about a little bit about the connoisseur style, which kind of, I think, in some sense appeals to me and is something that I kind of tend to relate to. Now, connoisseur is a successful investor, right? And like any connoisseur, or for a simplicity's sake, let's say a connoisseur of wine, right? Typically, if you notice on a table, there is a connoisseur of wine, he doesn't gulp the wine. He looks for the finest wine on the table. He takes that wine, he smells, he kind of swirls it, and he takes a tiny sip of it. And then he kind of experiences in his mouth. And over a course of the entire evening, he will have half a glass of wine. And that's all the wine he will drink, of the finest wine. But the entire evening, he will take small sips of it. And to me, the example that Lee Freeman talked about as the connoisseur investor related very, very closely to that connoisseur of wine that I am used to. He says connoisseurs find unsurprising companies, right? Companies which the average investor has not yet seen, has not yet experienced. So these are companies that are not yet in the limelight. They are not yet discovered, so to say. So he does a homework, he finds beauty in the ordinary, let's put it that way, right? So he has done his homework, deep conviction and faith that this company will kind of perform well. And as a connoisseur, he is not contented with small returns. He is looking for what we call in the investment parlance a multi-bagger. What do I mean by multi-bagger? Even when I'm investing in that stock, I am saying for every 1 rupee that I put in, I want the outcome to be 5x or 10x. So when I get the money back, it must be 10 times my investment value or 5 times the investment value. That's how I'm going into that portfolio. I am looking at allocating a reasonably large chunk of my money. So let's say I have 1 crore rupees. I am not buying 50 shares of 2 lakhs each. As a connoisseur, I am probably looking at 3 stocks where I'm going to put 30 lakhs, where I have high conviction these stories will work, rather than spraying my money across a lot of companies. And if for some reason, like what's been happening in the marketplace in the last couple of months, the stock market did take a tumble for a variety of reasons, whatever. The stock which I believed would give me 10x is down now maybe to 40% down or 30% down from the value I bought. I am willing to do homework and buy some more. I am willing to I have money outside, the author calls it gunpowder, to buy more of the same stock because I hold high conviction. If I was buying that stock at 100 rupees and for some reason the stock is now down to 60, why wouldn't I buy more? It's a 40% stock market discount available. As we do in a shopping, I would want to go and pick up some more of that stock. So that's the conviction with which he enters the buying story. And a connoisseur is somebody who comes into an investment with a pillow. That's what Warren Buffett used to say. Somebody asked Warren Buffett, what's the holding period for your stock portfolio? He said forever, right? While most people who invest in stock market come with a 1 year, 2 year, 5 year horizon, real big investors who want to make it big come in with the idea that I want to stay invested as long as the company is doing what it's supposed to do and what I think it should do. I have an indefinite period of holding in that stock. That is what he describes as a connoisseur investor and one of the finest investors who have managed his portfolio. And I think that I am able to relate to. And you had n number of instances in the past when some of the stocks were badly down and there was great opportunity for people to pick up, yet most people didn't go there. And those stocks today in 4 or 5 years are up 4x and 5x times, right? It's clearly something that I'm able to relate based on what I have seen of stock markets and stock investing. I'm going to pause here. I'm going to bring in AK Narayan. I'm going to ask him which of the traits he is able to relate to, and if he can, from his experience, talk about one of those traits or give us an example or insight into that, that'll be great.
Thank you. I also started investing since 1984, so long time back, and I was started accumulating shares of different companies, whether through IPO or through the secondary market. The 84, 85, even SEBI was not born. So what happened was there is no regulation and things were in a very disarray. But some of the IPOs which I invested at that point of time, even today, if I look back, it has done extraordinarily well. For example, I don't know whether you remember, there was a company called SKF in those times. They used to manufacture iodex. So that company, or the SKF came in public issue at 8 rupees premium with 10 rupees at face value. I applied 2-3 applications. That time people make in the family name and all that. So I got about 50 shares of allotment. You'll be surprised. Even today I'm holding that share since 84. Because I thought, why to sell that? Because they're giving 5,000-6,000 dividend every year. And it got merged with Glaxo, Burroughs Wellcome. Now it becomes SmithKline Pharma. And the number of share also has gone up. So this is one set of example I can always give you. But during the internet boom or whatever you call, that boom of 2000, so many examples were given to people to buy left, right and center. And some of the shares really went so high, I can't believe it. Some of the shares which we bought went on. You said 5x, 10x. I still remember there used to be a company called Visual Soft from Hyderabad. At 10 rupees when we purchased the share, I thought 10x, whatever you're saying, 100 is a great sell. But then, when I sold it at some rate of 2,000 rupees or something, it went on to hit 10,000 rupees. Then I don't know how to, where will you place in this book? I don't know what kind of investor, you said 20x, 10x is a great thing. So likewise, at every stage, there were companies coming like this. But one good thing which I used to follow is you need to buy companies with a good management, and corporate governance is the key. This is what I used to tell people. If the promoter is good, integrity is good, the product is good, and if the profitability is in par, please buy that share. But otherwise, don't look at that company at all. That is what I used to preach people, and that has helped me a lot. I remember still when during our association, Tamil Nadu Investor Association meeting, every alternate Sundays we used to meet. During Harshad Mehta time, every Sunday we used to meet. And huge gathering will be there. I'm talking of 1992, 93, 91, 92. 200 people will be there till 1:30 to find out what Harshad Mehta's tips are, latest tips. And once he came to Chennai and he went into a time house, so everybody thought he's buying some share, and a lot of requirement, a lot of people are buying that share. That's how people are. And I don't think it has changed a great today also. That is the story of it. People want to make quick money. This is not a place to make quick money. That is what I'm telling again and again. If I'm saying relating the figure of 1984 and 94, the idea to tell you all is equity is an asset class like any other asset class, but buy it, keep it for getting a decent return, and don't look at phenomenal return and don't think you can become a rich man overnight. So this is what this book also says. If you're going to lose 10%, 100 rupees you buy, you come back to 90 rupees. To recover that, you have to break even itself, you have to get another 11%. And if you're going to lose further 30%, then you have to make up 50%. And if you lose 50%, he says 100% you have to make up. That means the share has to come back to that level. So don't wait like a rabbit and don't stay on with holding on to the share. If you know that prices have come down by 20%, the best option will be to cut off, sell it off and think it's a bad experience. If you can do that, I think you will be a successful investor rather than holding on to the share, think that one day it will come back. It will never come back. The shares are such that it will never. What we have seen in the small cap companies in September, 800 rupees, 1000 rupees, just come back to 300 rupees today. You think it will go back to 800 rupees in a hurry? It will not happen at all. So we must understand the ground reality and cut it off completely. There are innumerable instances where I have seen company shares going up and whether it is due to manipulation or whether it is due to promoters buying or whatever you can call it, but the shares are giving phenomenal growth in some of the sectors and companies. But one thing I can tell you, you must be a contrarian. What Babu was asking me, if things are very bad for an industry, maybe that's the right time to look at that share. I still remember in one of our meetings, Ashok Leyland was quoting around 27 rupees. I'm talking of 15, 20 years ago, a 10 rupee share, 2000 or 99. So when we were discussing, we used to say some of the companies and all that. So when we are saying, why not buy this local company, good company, automobile will always have a good growth story. Then one man got up and said, no sir, they are working only 3 days a week. So that company doesn't have orders, don't have any future. It is not the way to look at it. Because it is working 3 days, because there is no demand, the share is quoting at 27. If the company was working 6 days, the share price would have become 150 or 200 rupees. That's how you must look at it. So you must apply your mind and look at those kind of shares and then grow along with that. Same thing holds good for Godrej Consumer. I still remember we were discussing in our meetings at 27, 26 rupees. People are reluctant. They say the FMCG is gone case. It will never be a gone case. A good promoter with a good product will never go anywhere. Please look at that more often than anything else. This is what I can say, Babu.
Thank you, AKN. And some life lessons from your equity adventure relating to this book, if you can relate to, and that'll be great.
Absolutely.
Thank you.
I will actually take off, Babu, from where you brought in the Roger Federer example, that he told he lost 52% of the points and still won. I mean, the question is, how did he win? The point is, he won the points that mattered, and the points that didn't matter, you can lose. And I think in investing also, why did these investors make money is that when they won big. So that you can have a lot of small losses, but that one big win will compensate. So I think that's where it goes back to saying that, you first need to have patience. And then when you win, you have to win big. It's the same Roger Federer example. And then again saying that, what type of an investor I am. I would say I'm a connoisseur, but by accident. Okay. I don't think I, learned and became a connoisseur. If I had to go back, my investing experience, probably started in 91. When whatever I had invested went down to zero because of Harshad Mehta's scam. Okay. And that was probably a very good learning experience, because then you realize that, this can, scotch you, you can get burnt. And after that, typically, nothing happened to the market. I think for 5-6 years, the market, nothing happened. And then at that point in time, again, being a good mutual fund man now, even at that point in time, I think it was already ingrained in me that I really didn't get into stocks, because again, getting into stocks is very difficult. Okay. There are two parts to it. One is first making all the analysis, you have the time making the analysis and then making the buy. And the second one is actually executing it. As Lee Freeman-Shor is saying, if buying is easy, executing it is even harder. It's like, if you think making money is easy, preserving it is harder. So at that point in time, I think I pretty much moved on, away from getting into these individual stock shares where you never know what sort of, rigging is going on, what sort of information is there, information asymmetry. And so I've been, for a long time a mutual fund investor. Luckily or unluckily at that point in time, I was not here and I was saying, I was overseas. And that funds just went and luckily there was no Grow and Paytm for you to look at it every day. So you probably looked at it once in 3 months or 6 months, and since it kept growing. And then after about 5-6 years, you realize that the best thing I did was I did not look at it, did not do anything. No action was the best. And then I realized that probably this is the only way to make money, having lost money, trying to do some stock trading. So I think that is how I became a connoisseur, completely by accident, it was not thought out. And I think that has stood well, over the course of the next, 15, 20 years. And I think in a country like India, it is very easy actually to be a connoisseur. I don't think there is a necessity to try and be any other. Because if you think that this is a growing economy and if the economy is growing by 6.5%, nominal GDP, sorry if I slip into my usual marketing spear here, then your, real GDP and nominal GDP is growing at 12, 13. Any company should grow at 1.5 times that, so making a 14, 15% return is pretty much a slam dunk if you're there over the long term. And even if it is a very diversified portfolio. In fact, I completely disagree with Lee, Shor when he says that mutual fund managers, are doomed to fail. I don't think so. It probably might be the case in a developed economy, but I don't think that is really the case in a country like India, where you can really get a 12 to 15% return as long as you are patient and you are invested over a longer period of time. So I think, that is the, in terms of what I've become, I'd say is that, a connoisseur by accident. And also if you had to look back, it is very difficult to be an assassin or a hunter. Okay, that is what, Lee, he says he's talked about 5, I think, 5, and 2 of them are assassins and hunter. An assassin is someone who ruthlessly cuts his position when the stock falls 20%. Okay, and how many times can you do that? And he's saying you take, and he's also saying you'll have to take a big position size. There is no point in having, as Babu was saying, 2 lakhs invested over 50 companies. You need to take, big chunks. And of that one big chunk, 20% is gone and then you cut it. I mean, it requires phenomenal amount of courage and, behavior. And I don't think many people have it. I think there are very, very few people have it. And I think one of the things that, as an investor is to know your trade and be comfortable in your skin, not try to be something which is very difficult, because I don't think a rabbit can become an assassin. It's impossible. A rabbit is someone who really doesn't do anything. He puts it and then hopes and prays it goes up. If it goes up, fine. If it falls down, tough luck, he's trapped. And the other one is also equally difficult, is a hunter. So the hunter is someone who's a drop 20%, he will buy more. Okay. While yes, in hindsight, as you said, it was down 40%, you can buy, but at that point in time, you put in substantial chunk of your money, it is down 20%. Again, to buy becomes difficult. And again, all stocks which fall don't go up. In fact, again, he gives a wonderful example. He says that almost 60% of the stocks which fell below 20% did not go back up. Only 30% went up, which means other 70% never went up and saw the heights. And the important question to ask then is that he says that, will you do now, knowing what you know now, what you did earlier? So which means if you had earlier bought it at 100 rupees, now the stock is at 75 rupees. Now knowing what it is, will you buy it? Very difficult. It is easy to put it in paper, but now you're so, muddled, 35% is lost. You can't take those decisions. That is why, I think it is better in the hands of a diversified professional manager than trying to, be a hunter or try to be an assassin. The other one, which is what he calls the raiders, which I think most people are. I think most of the Grow and Paytm investors are raiders. You go, it is up 2% today, you exit and you come out. But in the end, you'll never make much money. Because over the period of the law of averages, you make 5, you will lose 7, and net, it is brokerage is all you paid, and the only winner is the brokerage house. No one else has gotten anything. So I think with giving all this, I would think that, it is actually easy to be a connoisseur. It is not difficult to be a connoisseur. All you need to do, as A.K. Narayan sir was saying, was that be patient, trust in the overall progress of the economy, and obviously if the economy is growing, the stocks will grow, and sit back and relax. So I think that would be my, submission.
Thank you, Loganathan. That's a ton of insights. Thankfully, we have a video recording which we can go back and kind of refer to. With that, I'm going to get to a little bit controversial, but a quick round, is that in our life journey, and I mentioned it earlier, that we have 20 years of individual experience in stocks. I'm sure we've all made mistakes. I want each of us, if we can kind of talk about one thing which you can turn the clock and undo a mistake that we did in our past, so that becomes a reference point. And I want to start with myself, right? Like Loganathan said, today I truly believe a mutual fund negates a lot of individual stock picking problems. But back in the days, I did make a lot of mistakes. I still do. Only thing that I'm able to relate to some of those mistakes. In the good old days, there was this Times Bank. There was a bank called Times Bank. I don't know how many of you all are aware. The Times of India used to run a bank at one point in time. They came out with an IPO as well. I was one of those lucky guys to get allotted 1,000 shares. And for a year or two, the share price didn't move much. It was right there until HDFC Bank came along and acquired Times Bank on some swap ratio. I got a bunch of HDFC shares for my 1,000 shares of Times Bank. And the moment it got converted to HDFC, the price moved up just a bit. Right? I must have seen about 15% profit for 3 years put together of that investment. I rushed to my broker. In those days, there was no online, there was physicals. So I rushed to my broker and I said, please sell. It's 15% up for 3 years, which is actually 5% a year for my 3-year investment. And I sold it all. And I must have had 400 or 500 shares, I don't remember the number. I was doing a calculation about 2 years ago when I had some free time and I wanted to regret a lot of my things. I discovered that if I had held on those 400 shares of HDFC, 10 rupee shares of HDFC at that point in time, it would have been worth about 12-14 lakhs of rupees or thereabouts now, or 2 years back. And I don't even remember what I did with the money. I sold those shares and they came into my bank and I don't know where they disappeared. Right? And exactly the point he talks about, like he mentioned about the hunters. So he says, don't look at these tiny profits in stocks. Don't look at a 10% upside, 5% upside. If you're in stocks, like, in cricket, they always say, if you step out of your crease to hit the ball, you're taking a big risk. You could be stumped, you could get run out, so many things can happen, right? So the payoff for that should be that you should try for a 6. If you step out of your crease to hit a ball and you take one run, it is not an even payoff. Similarly, in stocks, if you're getting into a stock, then go all in and look at a big multiple. I did that mistake and I didn't do enough homework. I didn't have enough conviction then. I'm talking about 20 years ago. I am much more wiser now. Not that I do so much of stocks now, but I believe that you will need to give time for any of these investments to mature. So that's my learning, where every now and then when I want to feel regret, I just open this calculation and look at it. Yeah, I should have had 14-15 lakhs of worth of portfolio now, which I don't. So over to you, sir.
A lot of regrets are there for a person who has been investing for so long, and nobody can deny that, because so many companies came in between, and 84. Yeah. But like what you said, in 2000, when the Ketan Parekh scam broke out, I had sold some shares, and when I met the broker for some money, it was about, if I remember right, it was some 40,000 rupees or something. He said, sorry sir, I don't have the cash, but I can give you some shares instead of that, he said. So I said, instead of cash, you will give me shares. So he also told me that Ketan Parekh scam has broken out now. So you have to take the share, and tomorrow morning I am closing the office. So I said, what to do with that? So I said, what share you are giving? He said, I'll give you 1,000 shares of Eicher Motor. So Eicher Motor is a good company, I heard about it. So I said, then I also bought some shipping corporation, he said he has got. So I bought those 2 shares, he gave me that for the amount he has to pay me. So it's about 40,000 rupees or 35,000. It is 15,000 plus about 18,000. But he told me one thing before I left. Eicher Motor, sir, don't sell it. He said, you are closing the office and you are giving me advice. I said, forget it. So I went away. Then I didn't do anything with these 2 shares, because shipping corporation gave me a dividend of huge dividend, 18 rupees per share or something like that. I got some very huge dividend next year, some 18,000 or something for this 1,000 shares. So I thought this share has become free. Let it be there. Why to talk about this? So Eicher Motor, I was just keeping quiet. Then the Eicher Motor, suddenly I saw it moved to 100 rupees from 10 rupees. I said 10x it has come, so what to do now? So I didn't do anything. So I can't talk to this man because he closed and went away. So I was just watching and then talking to a few people. They said it's a good company, it may revive. So it went on to touch 1,000 rupees. So 100 times. So I said, we have made money. So why not we sell 100 shares? So I started selling 100 shares, 200 shares like that till 2,500 rupees. But can you believe, Babu? The share hit 35,000. What can you say now? 35,000 rupees, 3.5 crores. The worst part is that shipping corporation is still with me. Because it is free. So what more regret one person can have than this. But then, as you said, 20 times you have made money, so no problem about that. The other one was, one gentleman came and told me, sir, you have to buy one company called J Corp at that time. It was quoting 5 rupees. I said, this company is going to, absolutely good for nothing share. I don't want to buy it. He said, no, sir, you must buy it. From nowhere he came and said, you buy it, and I bought 1,000 shares of that. So I bought that, and ultimately it went on to become 100. I said, 20 times it has grown, and let me sell it. Then he came and told me, Narayan, you must buy some more. I said, 20 times it has grown, again you want me to buy? I said, I'll keep quiet. Then it went on to 500 rupees. Then also he came and told me, please buy it. I said, I will not buy this. I'm going to start selling, I said. From 750, I thought I'll start selling under 100. At 1,500, I got out of the 1,000 shares. Can you believe what rate it went? It went to 21,000 rupees. So what a regret. I don't know whether it's a regret or loss of profit or what to say.
Thank you, sir. Look, finally, quickly to you, what is that one regret you have? Go for the questions now.
Done. There are a lot of regrets. I have I can recite the regrets throughout the evening. But I'll tell you, the latest regret I would have is that the post-COVID rally, I didn't see it. All right. In hindsight, if we had seen that, I would have really, we got to put a lot more money in mutual funds. I would definitely not gone into stocks. So I think that is a, regret, because after so many years, you can still make mistakes. You think that you've been in the investment area, that you are reasonably aware of what is happening. But then again, that's what emotions take over, because post-COVID to really go in and invest, required a little more courage than what was normal. So I think my biggest regret is that, after all these years, you still make mistakes.
Thank you, Loganathan. Well said. We are never masters of our emotions. We continue to kind of be, controlled by emotions irrespective of years of experience. So that's a great learning. But so we have a bunch of questions. I also want to ask the audience here, those who have come in person, to keep your question ready. But I'm going to read the question which is here. To Mr. Narayan, this is your question. What kind of mindset do you recommend for Indian investors to develop resilience and execute their strategies? Rahul from Salem wants to know.
It's a good question from Rahul Salem. See, I feel that, like I said in the opening remark, if you are looking at a long term and if you are having patience, you are going to be win. But only thing is, you have to back the right horse. If you go to buy a company like Kingfisher or NEPC Agro, you're going to be the loser. So look at good companies and buy a share, maybe a 2-3 lots, don't buy in one shot. But your mindset should be to look at long haul and don't look at short term. It is not T20 cricket. It is a test match scenario. So you have to wait and then watch and then things to grow. And you are not making any mistake by investing in an equity market. So practical advice will be to buy small quantity of shares at different levels over a period of next 6 months and then create a portfolio so that you will not make any big mistake.
Thank you, sir. Thank you. Very valuable. Loganathan, I'm going to put the next question to you. Many investors struggle with knowing when to cut their losses and hold on to a position. What practical advice do you have for investors in making these tough decisions?
Yes.
From Daniel, Bangalore.
Good. Thanks. I think it's a very pertinent question. I'll give 2 answers to it. My first answer is don't invest in stocks. Okay, invest, in mutual funds. I'm not saying because I'm from the mutual fund, because it is very difficult, to invest in stocks and make money, unless it is your day job, you're not going to make money unless, you have developed a lot of expertise and have learned to control your emotions. If you still want to, do that, what I would say is that, I think follow what is there in the book. Have a predetermined stop loss. You've gotten into a stock, you think you've done your research well, but still the stock is down, once it's down, let's say 20%, and the author says 20 to 25% is ideal, where you'll have to take a decision either to sell or whether to buy more. Okay, so if it's down 20%, and based on what you know now, will you buy it or not is the question you should ask. And if the answer to that is no, then sell it. And if the answer to that is yes, then buy more. Okay. But having said that, it is very difficult to execute it in practice because, we are not trained professionals to have that heart. And even the trained professionals really do it because it is other people's money. It's so much more. It's natural. It's so much. It's because emotion goes away. You can take a decision. It's not that they are mishandling your money. They can take a decision which is not driven by emotion. That is the difference. Why do people take wrong decisions? Is essentially because emotions muddle with your rationality. And when you're investing in a stock individually, that muddle will be always there, unless you're extremely, good and are able to bifurcate it. And that's why you go to a professional fund manager, because to him, it is demarcated. He can look at it very objectively. That's my.
Thank you, Loganathan. Sir, we need quick answers. Now 30-second answers. What's your point of view, sir, on compounding? Do we need to stay invested for longer from Sanjana?
See, if you want to achieve power of compounding, definitely you have to stay invested. I'll tell you a simple example. Somebody invested from 1st July 2002 till today. They have compounded at 18% rate of return. And, 5 lakhs.
Is that some person, A.K. Narayan?
5 lakhs of rupees is today 6 crores. Same thing, I'll tell you one more analogy. People think gold was 500 rupees a gram in the same time, 1st July 2002. Today it is 90,000. So automatically, you would have made 90 lakhs. So where is 90 lakhs? Where is 6 crores? Which is better asset class? You can decide.
Okay. What specific 3 shares or stocks can we? That I will pass, my friend. I am not going to. We are not going to be drawn here. Pass on all our behalf. Thank you so much. This is not a tip giving. We want you to read the book. Yeah. So the best investors go wrong but still make millions by executing strategies wisely.
To answer the second part of that question, or which 3 mutual funds, again, I would say, don't invest in a mutual fund, the names, there are 40 out there. I think invest in a cap curve, invest in a large cap fund, invest in a diversified fund, invest in a mid and small cap. If these 3 are there, by and large, your investment is done. There is no better expert than A.K. Narayan, sir, to say that. So I would.
Well done. Thank you. So the best investors go wrong but still make millions by executing strategies wisely. How can mutual fund investors ensure they are aligned with fund managers who execute effectively? This is to Loganathan.
Yes. Yeah.
The mutual fund question.
See, the way is to look at a mutual fund house. What is its track record? How long has it been there? Look at how some of its funds have performed over a period of time. Do not look at a short-term performance. Do not look at the last 2 years, last 3 years, So see, and also look at the management, the quality of the fund managers. And I think once you're able to have a track record, then I think the decision becomes much easier. So I think that's all I would say, and typically all mutual fund houses always, professionally manage the company, manage the funds. And it is not to say that you cannot invest in a new mutual fund which has come. That is not the case. You can't wait for a 20-year track record, before you invest in a new mutual fund. Look at the track record. Look at the fund managers who are there. Look at what has been the previous experience. And once that is established, I think, you should be able to go ahead and invest.
Thank you, Loganathan. The next question was a very interesting question. There was one more question I saw. What is safer, mutual fund or FD was the question I saw. I have a very important comparison I make. I normally say the ship is safest in the harbor, but that's not what it's made for, right? So your money is safest in FD, but I'm not sure it will serve your long-term needs if all your money is in bank or in fixed deposits. So certain amount of your money should take risks. And the mitigation of that risk happens if you invest in the right product and stay invested, like A.K. Narayan said, over a long period of time. So next question, is there a correlation between performance of a company and the share values of the company? Yeah.
See, there is definitely a correlation. The share price doesn't go up just like that. The revenue has to go up, profit has to go up. These two are the important parameters. That is why people say the earnings are very important. If you are buying a good company where earnings are good, automatically the share value will automatically reflect in the company's performance and the shares. If the company is making consistent losses, the share price cannot go up unless something happens elsewhere.
Unless it's Swiggy or Zomato.
Correct. So don't do that. So definitely there is a correlation between performance of the company and the share value.
Narayan, you're getting a lot of questions to Mr. Narayan. Even the best investors make mistakes. Of course, the reason he is best is because he has made mistakes. From your experience, how should retail investors handle losses and learn from them instead of being discouraged? From Ravi, Chennai.
There is no question of getting discouraged here. Lot of retail investors are sucked into the system, like what Babu said in the initial period. Lot of people think that they can get into direct mode of shares. Please, like Loganathan said, the initial phase of your investment should start with mutual fund. Thereupon, you can graduate yourself into shares with your experience and expertise. Don't get into that. You are not going to college directly. You are going through the school, then you are going to college. Same way, the going to the equity market is like going step by step. But now, even beyond the college, people are going to futures and option directly, like what Babu was saying. That is why people are losing money. So definitely don't have to feel bad about this. Study well, attend programs of this type. Your awareness and investor education helps you to grow better and better. I must thank all of you for coming on an evening like this and patiently listening to us, and it makes lot of difference to us. That is what, when I said Tamil Nadu Investor Association, when we started in 1990, we never thought 35 years people will support us and continue to work with the association. And if you are not a member, I would urge upon each one of you to become a member of that association, and you will continue to learn from that association very much.
Thank you. Thank you for promoting Tamil Nadu Investor Association. As an initial investor, what are the 3 major points of your wisdom from your experience?
Okay, so I will assume that you're asking as a stock investor.
As an initial
As an initial investor. Okay. If you are going to invest in stocks, I would say that, first know your type. Are you someone who can take a loss, or are you someone who can, have a sleepless night if the market is down 2%, 3%. I think that is very important. And once you know what type you are, I would say stick to that. Don't try to change it and modify your investments towards that. I'll give you my own personal example. After all these years, I'm still a very conservative investor. Even in mutual funds, I put in small lots of money. Because that is who I am. And once you're comfortable with who you are, then you sleep easy at night. You're not trying to be someone else who you're not. And I think that is very important as an investor to know who you are and follow that. And I think that will take you almost halfway through success. The second one I would say is that never ever do F&Os or never ever leverage. The moment you leverage, you are really letting yourself, to be bankrupted. So I would say that would be the second most, I think that they wanted 3 points, correct? I think these 2 are good enough.
Repeat the second one again, third. Yeah. Don't lose money. So like Warren Buffett has the famous thing, right? Rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1, right? So similarly, we can use this. So last question I'm going to quickly take. Which asset class should we choose? Equity, gold for long term, 5+ years. Dot say 60% equity, 20% debt, 20% gold, equity, gold. My friend, the essence of this talk is, I think, as AKN said, is that the best way to prosper in the future is that none of us know what the future holds. Equity, gold, debt, and real estate, in whatever formation that you think is good, is how you should approach it, how comfortable you are. There is no one asset class where you should put all your money, and that's a bad idea. So keep your investments in all buckets. Some bucket you can have more because if you're a real estate person, you can have a little bit more in real estate because you like that asset class, you understand that asset class. If you're an equity person, have a little bit more in equity. But make sure that you diversify your portfolio, and that's how I would kind of say. We're completely run out of time. I wish we could talk longer. All 3 of us are passionate, but there is a program and we are well past the time. So thank you so much to both my panelists for being here and all of you all for being here and asking such lovely questions. Over to Group Captain Vijay Kumar.
Thank you, Babu. I know each one of you have become more wiser to go invest. Thank you, viewers. We have more than 480 viewers watching on program line. Thank you for sharing so many of the questions. Most of the questions they covered during the discussion. Big round of applause to the district panel this evening, who prepared so well and answered all the questions. My request now, Mr. Narayan, our Senior Vice President, also Sundaram, please come on the stage, do the presentation. Venkat, you can also join me on stage. Thank you, ladies and gentlemen.